Hi, I'm David Traversi, and this is part of our series called How to Sell Your Business. Will you, as the seller, receive the value of your company in cash at closing? Well, in 2 words, it's unlikely. Once you and the buyer agree on the value of your company, there are a number of factors that come into play that reduce the cash you receive at closing. We'll address each one of these. Business debt must either be paid off or assumed by the buyer. In either case, regardless of an asset sale or stock sale, the repayment of debt by you or the buyer's assumption of debt reduces the amount of cash you receive for the sale. In an asset sale, you will need to take the money that's paid to you for your assets and repay any business debt you owe. It could be that the buyer agrees to assume your business debt, but the buyer's assumption simply means that it will come off the purchase price and leave you with the same amount of money as if you took some sales proceeds and paid off the debt yourself. In a stock sale, the buyer buys the entire business, all assets and liabilities, and considers the assumption of debt as part of their payment. In our case study with Patsy's Paws Pet Place, with $1 million in debt, has EBITDA of $1 million. The buyer is willing to pay 6 times those earnings for the business. In scenario 1, the buyer agrees to buy the assets of PPP for $6 million in cash, and then Patsy must pay off the debt of $1 million. Patsy will net $5 million. In scenario 2, the buyer agrees to buy the stock of PPP for $5 million and assumes the debt of $1 million. Patsy will net $5 million. Let's talk about another reason why you might not get all your cash at closing. The price may include holdbacks. Most sales of businesses include holdbacks for various reasons. This is money that the buyer holds back from the seller to cover any number of cash needs that may arise after the closing that are rightfully the obligation of the seller. For instance, the seller may agree to indemnify the buyer for any warranty claims made in the 12 months following the closing. The buyer will likely require that an amount likely to cover any such claims will be held back, sometimes in escrow, sometimes not. And it's not unusual to see 10%, even 20% of a sales price held back for payment at a future date, usually in a year or less. Hopefully, if no claim is made by the buyer against the holdback, you ultimately receive this as part of the purchase price. Another situation is the parties may have agreed to an earn-out. An earn-out is an agreement in the purchase and sale agreement that part of the purchase price will be dependent upon the buyer being able to earn a certain amount of money after the sale, usually defined as either revenue, gross profit, or net profit. So an agreement may say buyer will pay $10 million for the business, but $1 million will be conditioned upon the buyer being able to earn at least $5 million in revenue in the next fiscal year. Or it may say buyer will pay $10 million for the business at closing, plus an additional 5% of sales generated in the 12 months following the close of the purchase. Or perhaps buyer will pay $10 million for the business at closing, plus an additional 10% of EBITDA generated in the 12 months following the close of the purchase. Earnouts can be very complicated and risky for a seller. You may be counting on this money as part of the purchase price, but there is a significant risk that you will not receive part or all of it. This is, of course, because the buyer now controls the ability of your former business to earn the threshold for payment of your earnout. And even if the buyer manages the business well, the market itself may let you down and prevent the business from earning what it needs to earn to justify your earnout payment. We generally advise our sell-side clients against accepting an earnout that will be calculated on a net profit or an EBITDA amount. This is because the buyer, once in control of the business, has a lot of latitude to manage the business in a way that reduces the earnout payments to the seller. When earnouts are necessary, we strongly recommend that the earnout be based on top-line revenue measures, where a seller can be more comfortable that there will not be any manipulation of those numbers. Okay, another situation is that the buyer may only agree to pay part of the purchase price in cash at closing and pay the other part as a consulting fee to the seller over time. This, of course, has tax implications, given a consulting fee would be subject to ordinary tax rates versus capital gains rates that may apply to the sale of your business. And it's risky, given the buyer could default on your payments and perhaps never pay them to you. Another situation is that the buyer may demand you finance part of the purchase price. In other words, the buyer may want to pay you a portion of the purchase price at closing and then sign a note that obligates them to pay the remainder at some future date. In general, we are opposed to seller financing unless you badly want out of your business and literally have no other options. The reason is the buyer may well default on the note and you will be left with limited options to collect. You can try to foreclose, which will likely require a costly court action, and the buyer will likely assert all types of defenses to your action. In fact, we generally advise as between two offers, one significantly higher, asking for seller financing, and the other lower but all cash, to accept the lower all cash offer at close. If you are forced to finance part of the purchase price, try to, number one, get as much collateral in the form of hard assets as you can, for instance, even a deed on their home. Secondly, is make the term of the financing as short as possible, given bad things often happen for a lender the longer the debt is outstanding. And third, work with your lawyer to eliminate any contingencies affecting your right to collect on the note. Okay, in all these episodes, we've had to spend a lot of time on valuation and other basics, but your understanding of these things is critical to ensuring a successful transaction on the best possible term. In future episodes, we'll move on to deciding whether your business is ready to sell. So thank you, and look for future episodes of How to Sell Your Business.